Today, I think you find a wide variety of lenders, including a lot of regional banks, which hold a lot of these real estate loans. So we think it's going to be a big opportunity. It's not just going to be an office. Apartments are going to be a big opportunity as well. We think that it's important to buy good real estate. At the end of the day, cheap doesn't get cheapen up if you don't buy the right thing. So, the better properties are going to continue to perform okay, but I think there's a real opportunity for bottom fishing now and over the next several years.
So speaking of cheap, Scott, the last time you joined us, and you've been kind enough to give us your time over the last 6 months or so, preparing for what you've called an epic opportunity last year, both from the gain side and the pain side. I think that we talked about office buildings here in New York going as cheap as 25 cents on the dollar. I know it's very regional. What are our buildings, our properties, loans starting to trade, and what are valuations looking coming in as so far in the first wave of this?
Well, it goes market by market, but particularly for obsolete office buildings or kind of B- office buildings, the big talk in the industry is to convert. If you look at Manhattan as an example, too much office space, too little residential. It's too expensive to live here, and there's too much office space. And the notion is that some of these buildings are going to be converted from office to residential. That is a very tall order.
It's hard to do, right? Like, you just don't flip a switch and say bye.
Right, and because light and elevators are the two big. Light access and elevators are the big issues. The floor plates on office buildings tend to be too big to be laid out really well for apartments. Interestingly, the older office buildings, which have smaller floor plates, are easier to adapt. But we did one through PTM in Washington, D.C. It's not easy to do, and I think it's really kind of overblown in terms of how big an opportunity that is. The other thing I would say, just in terms of converting, is it's going to take a lot of public-private cooperation to make that happen. The economics in terms of tax breaks, help in financing, governments are going to have to find a way to get these buildings viable. And it's going to mean working with the private sector in a way that might appear to some to be too generous to the private sector.
But so in terms of those values, though, and understanding that it is market by market, region by region, if you had to put just a spectrum on it, 25 cents if that's New York City, but are you able to say some sort of average, just to give our listeners an idea of how painful it is and could be?
Well, I think less than half. And, you're going to see things that go for buildings that in their current use can barely pay their property taxes. So, you're going to see it values at a low, but again, is it good value even if it appears cheap?
Well, Alix only buys on sale. We're talking about clothes, but Alix, there's a few properties, office buildings out there.
I only buy property when my mortgage rate is 3% or lower, so I'm not your target audience.
So, do you prefer to buy the actual real estate itself or the mortgage behind it?
It is really deal by deal. I think you have to be flexible, because you've got to deal usually with the senior lender with a refinancing package, and with squeezing out the equity, partnering with the equity, cramming down the equity. The structure needs to be, I think, typically up in the capital structure. So either buying the real estate if the senior lender wants to go through the foreclosure and just sell the real estate, or coming into a structured alternative. But I think importantly, our perspective is that we have to be able to get control of the operations of the real estate, because again, particularly through this syndicator model, a lot of people that really didn't know what they were doing, that never would have passed the muster for institutional real estate capital, got into the business, and they're the ones that are in the deepest trouble.
So because of people like you, though, that can do that homework and then step in, will there not be a gigantic commercial real estate crisis? It's just going to be like years of sussing out this stuff and finding the right price?
Yes. I think there will be years of...
But nothing disastrous.
Well, it will be disastrous for the people that get wiped out. I mean, whether that happens overnight or over a period of a couple of years, a lot of these people are going to get wiped out. And I think it's a disaster for some as an opportunity for others.
And speaking of disaster, Scott, when you joined us in August, you alluded to the idea that the regional banking, that could be some kind of a banking crisis worse than what people were anticipating. And lo and behold, the second most popular article on the Bloomberg Terminal today, dozens of banks rapidly piled up commercial property loans. Speak to us about the regulation and what you see ahead here.
Well, I think interestingly, the big banks aren't that exposed to commercial real estate. If you look at J.P. Morgan, Goldman Sachs, Morgan Stanley, we've done the analysis on those banks, and I think they've learned their lessons, and they're not that exposed to commercial real estate. The middle-sized banks, a little bit more so. It's the smaller banks that have an inordinate concentration of commercial real estate loans, and I think part of the reason was that there was very little commercial loan demand during COVID. People weren't starting new businesses. They weren't, opening new restaurants and stores. And the sort of bread and butter business of a smaller bank didn't really exist. So they poured a lot of money into real estate, and they did so with floating rate debt, although everybody's against their cap on the floating rate debt pretty much, with very short maturities. So that's the big refinancing wave that's hitting these smaller and regional banks.